Thank you for joining today's webcast on COVID-19 fallout, determining the necessary short-term changes and best long-term tactics. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our Extended Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or unplanned background noise during our session. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we will hold your questions to the last part of the program. Additionally, in the handout section, you will find a PDF of today's presentation. Today's webcast is sponsored by Segal. To introduce his firm in today's webcast, we have with us today Andrew Sherman. Andrew is Senior Vice President and National Director of Public Sector for Segal. Andrew, the session's yours.
Thanks, Kim, and hello, everybody. Again, I'm Andrew Sherman. I'm with Segal, and I have overall responsibility for our public sector business. We are delighted today to be sponsoring this webinar with NCPERS, and we appreciate all the opportunities that we have, and we hold NCPERS as very important in our world, and we know that all of you do as well. Segal is a consulting firm with a key focus in many areas of employee benefits, but in particular on public sector retirement plans. We pride ourselves in providing our clients with trusted advice that improves lives, and we see our role as helping retirement plan sponsors protect retirement security for their participants, which is now more important than ever. It's my pleasure to introduce today's session and my colleagues who will be presenting their thoughts, observation, and action steps for retirement plan sponsors for the fallout from COVID-19, or at least as much as we know today, because everything seems to be continuously changing, and it's just therefore all the more important to understand the risks involved. All of today's speakers are part of Segal's Public Sector Leadership Group. Melanie Walker is going to be our first speaker. She's a Senior Vice President in Segal's Compliance Practice. She's a national retirement expert with a particular interest in public sector. She has more than 20 years of experience in retirement plans for the public sector and is very active in the broader benefits community. Wendy Carter will speak next. She's a Vice President at Segal and is our Director for Public Sector Defined Contribution Retirement Plan Consulting. She's a well-known expert in the field, writing and speaking regularly on these topics, and she has a particular deep expertise in data security. Rocky Joyner is the Senior Vice President and Actuary at Segal. He is our public sector retirement practice leader with more than 40 years in our business, and specifically consulting to public sector defined benefit retirement plans. Rocky is a true expert on the design and redesign of public sector retirement plans. He has a great understanding of risk and an incredible ability to find creative solutions to plan issues that are continuously emerging, again, with a particular focus on risk and how plan sponsors can address risk. I'm thrilled that Melanie, Wendy, and Rocky are here to present today. And with that, I'm going to turn the presentation over to Wendy. No, to Melanie. To Melanie. Thank you. Melanie?
Thank you, Andrew. Good afternoon and good morning to our audience out there. I will start with a brief overview of the CARES Act, or the Coronavirus Aid, Relief, and Economic Security Act, which was enacted in March 27th of this year. This act was specifically passed to address the economic impact of COVID-19, and its retirement plan provisions generally only apply to defined contribution plans. So we'll start with the only required change under the CARES Act, which is in Section 2203, and it waives all of the required minimum distributions that would be required under Code Section 401A9 from defined contribution plans only for the entire year of 2020. So even though this was enacted in March, it's retroactively effective as of January 1 of this year. It applies to both the first-time required minimum distributions, that's people that turned 70.5 last year, and also to ongoing payments that are made to plan participants, again, but only in defined contribution plans. If someone was already paid a required minimum distribution before either the act was passed or just because the plan had not yet figured out a way to stop payments, required minimum distributions, then they are eligible to roll that payment back into the plan. And we have some recently published guidance on this issue in IRS Notice 2020-51. And it allows these rollovers of waived required minimum distributions until August 31st of this year, and then provides sample plan language for a plan to implement this waiver of required minimum distributions. So participants who received required minimum distributions but did not want them can roll them back into the plan until the end of August. Next slide, please. So there are three main optional changes in the CARES Act. And the first is in section 2202A, and it allows in-service coronavirus-related distributions, we'll define that in just a moment, for the entirety of 2020. And the distribution can be for up to $100,000 from all combined defined contribution plans that the employer sponsors a plan for. So it's important to note that this in-service distribution provision does not apply to money purchase plans or defined benefit plans. So these coronavirus related distributions have some pretty important tax relief, and that is that the distributions are not subject to an early withdrawal penalty, no matter what the age of the participant when they receive them. And although they are paid out in a lump sum, they are not subject to the 20% mandatory withholding that is usually required on lump sums. Second, a participant or recipient of this type of distribution can pay the income tax over a 3-year period beginning in 2020. And if someone takes a distribution but wants to put some of that money back into the plan, they can roll it over back into their plan within 3 years of taking the distribution. If the plan does not accept rollovers, they can also roll it over to an IRA. It's important to also point out that even though this provision does not apply to money purchase or defined benefit plans, if a participant in one of those plans receives a distribution that is allowed under the general rules of the plan, they can apply these special tax rules to that distribution if they're eligible for a coronavirus related distribution under the statute. And they do that by using IRS form 8915-E to report it and elects the special tax treatment. So what that means is plans can do their normal tax reporting, whether it's from a defined contribution plan or these other types of plans that don't allow the coronavirus related distribution. And then it's up to the participant to report it and get the tax rate. Okay, next slide, please. Let's talk a little bit about what a coronavirus related distribution means. The statute provided two different types. First is a distribution that's paid to a participant who tested positive for COVID-19, or if their spouse or dependent tested positive for COVID-19, they would be eligible for this type of distribution. The other purpose is if the participant experiences one of a number of adverse financial consequences, which includes being quarantined, furloughed from their job or laid off, having their work hours reduced, being unable to work due to lack of childcare, or if they own a business that they have to close or reduce hours due to COVID-19. So those were the statutory provisions, but the statute left a little bit of room to allow Treasury to add additional adverse financial consequences once the experience of the pandemic told them that those might be important for this purpose. And they did that recently. Treasury expanded the definition of who is a qualified individual for a coronavirus related distribution. That's set forth in Notice 2020-50. And they added a couple of adverse financial consequences, which include someone having reduction in pay or having a job offer delayed or rescinded due to COVID-19. And then they added something that many plans had asked about, and that is if their spouse or household member experienced any of the adverse financial consequences that were set forth in the statute or in this new notice, the participant is also eligible for a coronavirus-related distribution. Next slide, please. So the next two optional changes are related to plan loans. And the first change is that a plan can increase the maximum loan amount, which is currently the lesser of $50,000 or 50% of account balance. And they doubled that to the lesser of $100,000 or 100% of the account balance. So if a person would have been eligible for a coronavirus-related distribution, they can take a loan of this increased amount if the plan adopts this provision, so long as the loan is taken within 180 days of the enactment of the CARES Act. And they could take either a coronavirus-related distribution or an increased loan, or both. They could be eligible for both. And then the second part of the loan changes is that any loan payment that was due from an eligible individual who met that test for a coronavirus-related distribution, any payment that's due from March 27th through the end of this year can be delayed for 1 year if the plan adopts it. We also have recently published guidance on this provision in IRS Notice 2020-50, and it described how these loan payments can be resumed once the 1 year delay is over. First, they provided a safe harbor, which indicated that if you suspend payments for the rest of 2020 for these individuals, you can resume those delayed payments plus interest on January 1st, and the entire amount would be re-amortized for an additional year. Then they also indicated that there may be other reasonable methods to do that, so they left it open for plans to do what makes sense for them. And then the final thing I want to mention about the CARES Act is that governmental plans have until the end of the 2024 plan year to amend their documents to comply with the CARES Act to the extent they adopted any. And I just want to put in a quick plug why that it may not be the best idea to wait until 2024 to amend your plan documents. If you have to do them by statute, then you want to start looking at the process for doing that right now, because it can take a while. And also, even if you have a separate plan document, separate from your statutes, and you can amend it as you want, it may seem silly almost to amend a plan in 2024 for things that took place in 2020 and have been over for several years. So consider adopting plan amendments early. And with that, that is the end of my remarks, and I will turn it over to Wendy.
Thank you, Melanie. This is Wendy Carter, and I would like to take a few minutes to talk about the impact that the coronavirus has had or will have on defined contribution plans. And in any situation, when there's change, it gets attention, good change or bad change. So what I'd like to do is just sort of walk through some of the impacts that we're predicting or already seeing in terms of the coronavirus and what's going on with the retirement plans. So with that, what I'd like to do is just start with, like, what is it that we already know? And I hate to say this, but, you know, in terms of retirement security and personal savings, we do have a lot of gaps in our safety nets. So for example, 63% of Americans can't cover a $500 emergency. And this is something that was getting a lot of attention even before the coronavirus, and with people having reductions, furloughs, and losing their jobs, it's really becoming even more and more of a concern for our financial security as a country. So with that, I'd also like to comment that there are other factors that impact our retirement security and our financial security, and one of those is student loan debt. Student loan debt's a big concern, and it's also more of a concern not only for millennials, but also for older individuals. So currently, there's about $1.5 trillion of student loan debt. Of that, almost $260 billion of that is held by Americans over age 50. And that, when I first saw that statistic, I was a little surprised, but then thinking about it, I realized that a lot of individuals who are trying to improve their financial status or have lost a job go back to community college, for example, for retraining and hoping to increase their, earning power. And you might find it interesting to know that 10% of community college students are actually 40 years old or older. So there's a lot of student loan debt out there, which is a drag on our economy. And during the coronavirus, repaying student loan debt is going to be an issue. Employer-sponsored retirement accounts are the primary savings vehicles for most employees. And I think many of you will find that a little bit of a surprising statistic because people don't have access to ready cash. Even individuals that have relatively good income, they often spend as much as they make and don't really necessarily have a lot of liquid savings other than what they're putting in their 457 or 401k plan, for example. And then lastly, and I think as a plan sponsor, you probably need to realize that you probably have some big shoes to fill. 75% of employees in a recent survey said that they trust their employer as a source of financial information and advice. So your employees look to you for guidance. They look to you for ways to improve their financial security. And I know that all of you are very interested in helping people achieve those goals. So with that, let me go to the next slide and talk a little bit about what are DC participants doing in their reactions to COVID-19. The first thing that you will all know and are not surprised by is calling the call center. Volumes are still, even now, within the last week or two, 10 to 15% above normal, and talk time is also up. So what that means is more and more people are calling. They're wanting reassurance, advice, guidance, wanting to know whether they're doing the right thing, should they be doing something differently, and they're taking up a lot of time with the service representatives on the phone to answer those questions. During the times when call volumes are high, many people are actually diverting themselves to the website or the mobile app, which is actually seeing a 25 to 35% increase in visits. And I think what's interesting to note here is the service providers, to some degree, will benefit from this experience, because when participants use the website or the mobile app and realize how quick and easy it is, they will be more likely to use it on a return visit. So very important changes in behavior, perhaps, that we'll be seeing. What's good news is that most of the individuals that are calling and that are talking on the phone to the call center representatives are not necessarily making changes. What they really want to do is talk to somebody about what's going on and make sure that what they're doing now is right. Should they do a little tweaking? But they're not making major changes. Only about 3 to 6% have made changes to their investment allocations, but the rebalancing is up so that they're going back to their target allocations. Many are changing their savings rates. 5 to 10% of callers are making changes. What's interesting is about half of them increase and half of them decrease. So at least from that perspective, it's almost a net neutral result. And then lastly, they're making withdrawals. And I think we're going to see withdrawals from defined contribution accounts continuing to increase as the coronavirus pandemic continues on. As of about a week or so ago, when I put these slides together, the withdrawal rate was only about 50% of what it had been in the first quarter of 2009. So it's not rampant, it's not as high as it could be, but I do predict that it's probably going to continue to increase, especially with the resurgence of the virus that we're seeing right now. Next slide. What are record keepers doing? So on the defined contribution world, those are the individuals on the front line, keeping everything running, balancing the books, and conducting the transactions. And one of the things that surprised me immensely and actually warmed my heart was that record keepers expressed solidarity when the coronavirus first occurred by waiving transaction fees for CARES withdrawals and loans. So I think that was them putting their money where their mouth was, and I think hats off to them. These record keepers, by and large, are still meeting call center performance standards. Daily call volumes and length have increased 10 to 15% higher than pre-COVID, but they're still meeting their standards and answering calls on a timely basis. They are leveraging technology, as I mentioned, and we're seeing 25 to 35% increase in web-supported calls. And then the call center representatives are helping employees with contribution changes, and about 50% increase, and as I said, 50% decrease. So we're not seeing necessarily big changes, but it is nice to know that people are calling and asking for assistance and getting guidance. I also want to just mention that the call center representatives, about 90% of them are now working from home. As a result of the pandemic, everybody was transferred to work at home status and many are staying there. Employers, record keepers, and service providers are evaluating whether or not they should go back to big call centers. And, there's some considerations in there in terms of disaster recovery, but something that many of the record keepers are looking at. Okay. Then lastly, what should you as plan sponsors be doing? Well, listen to Melanie and enact the appropriate CARES provisions. Encourage your participants to keep calm and stay the course. You are a trusted party with your participants and they'll listen to you. So just make sure that you keep them calm. Don't necessarily encourage them to make drastic changes. Another important step would be keeping in touch with your service provider. Those individuals are the ones that are on the front line. They have a lot of data to share with you. You may have a plan sponsor portal that you can use to look at results and see what's happening. And if you have field representatives out in the field for your 457 or 401k plan, make sure that you talk to the individuals there, the field service representatives, and what are they hearing and seeing and doing, and realize that most of them cannot meet with participants because of the virus and the social distancing and everything like that. So they're rolling out a lot more webinars and phone calls and video conferences. So keep your eye on that and what's going on. And then lastly, think about the big picture. When this is all over, what would you want to put on your list of things to do? And here was my sample list. Looking at emergency savings and student loan debt. As I mentioned at the beginning of this presentation, I think that's a real drag on our economy and on people's living styles and so forth. So I think you really need to take a look at that. Basic financial literacy and wellness, that's taking off across the defined contribution arena, and it really provides resources and tools that will help your participants manage their money and have a better financial status. Revisit your investment lineup. You may not need to make any changes, but you should probably just check and talk to your investment consultant about that. Consider retirement income projection statements as people are, putting savings into their accounts. What are they likely to get out of it, and how will that couple with your defined benefit or defined contribution plans that you sponsor for your employees? Also look at retirement income and spend down assistance from defined contribution plans. Those will be things that you want to consider. And one of the things I want to just close with a little statistic on what are called the sidecar savings accounts that are starting to get a lot of traction and helping people put aside money before they actually put it in their 457 or 401k plan. And in this case, a statistic I recently saw was this common contribution amount by participants in a sidecar savings account, which is, a $500 or $600 savings account, is about 4% of pay, which I found to be a heartening statistic. So overall, I think we want to keep calm and carry on. And with that, what I'd like to do is pass it over to Rocky to talk about how this affects your defined benefit plan.
Thank you, Wendy. Thank you, Melanie, both of y'all for your comments. Let's go to the next slide. There are three major areas of risk in DB plans. We always worry about investment return, contribution income, and how long people are going to live, we're going to have to pay benefits for. COVID has hit each of these major risk areas in different ways. For investment return, on the next slide, soon after the lockdown happened back in March, the markets took a nosedive. The Dow down 35%, S&P over 30, and NASDAQ maybe a little less than 25. But here we are 3-4 months later. As of June 29th, the markets had recovered significantly. The Dow was only now down about 11%, S&P about 6%, and the numbers I looked at showed that NASDAQ was actually on the plus side at about 9%. Do not take these as a final product. The markets remain very volatile. One day they'll be up 500 points, the next day down 600 points. But beware, but it's not quite the end of the world we thought it was back in March. Next slide. So what do you do? Most plans that I work with have taken more of a wait and see attitude. I remember a phrase in the medical field where the first thing a doctor has to do is physician do no harm. So in spite of the fact that there's a short-term issue, you don't want to do anything that harms you long-term. This is a graphic from a client that shows prior to COVID and without any changes in the investment return, they were on a march to get to 100% funding and doing quite well. COVID hits. Now, if we take two modeling for this, we modeled different COVID possibilities. One was a 0% return for 2020 and returning back to a normalized 7.25% in 2021 and thereafter. The other one was a minus 15% in 2020, maybe a plus 10% in 2021, and then moving forward from there. And you can see that this particular plan, if they stick with their knitting and keep doing what their policy says they're going to do, they are going to catch back up, even in spite of the decrease in the economy and the markets in 2020. So again, model some outcomes, take some sampling, see what it looks like, but don't go drastic in doing panic type moves. Next slide. Now, the other area is sponsor contributions. What are contributions having to the plan? And here you see a COVID impact on plan sponsor contributions. What we have here is a map of projected income for states around the country. But what we notice right off the bat is the impact is not distributed uniformly. You've got California, New Mexico, some of these other states where as much as a 20% decline in expected revenue. Other states, much less of a decline, some even less than 5%. I think that's Iowa and Utah. So these are subject to change, but the impact of a sponsor losing revenue from tax base means that there's going to be more pressure on the contributions for the retirement plan in keeping those contributions up. And we'll look at the next slide. So other entities, they're doing other things. They're sharpening the budget pencils by either not filling or eliminating positions. And so the plans can model the impact of reduced staffing, reduced workforce, and see what that does to contribution income. If an entity cuts staff by 10%, that saves a lot of money on the budget for the particular entity. But then the pension system has also lost 10% of their contributions due to that cutback. So other plans are taking and reviewing your funding policy. If you don't have a funding policy, you should go write one for yourself now. You need one. But in your funding policy, you should have things to tell you what happens when very difficult times occur. So look at that and see what kind of short-term relief you can come up with that would not jeopardize the long-term health of your particular retirement program. Let's go to the next slide. And then longevity and COVID itself, the actual disease. Similar to the income report, the impact of COVID is not uniform. Evidently, we're supposed to all move to Montana and we'd be safe from COVID, is what the map seems to tell me. But stay away from California, Texas, Georgia, and Florida, New York, Pennsylvania. Again, widespread, and even within the individual states, the spread of COVID is remarkably not uniform. In the state of Florida, for example, in South Florida, in Dade, Broward, and Palm Beach, the incidence of COVID is very strong. However, if you go up to the Panhandle, a little county up there called Franklin County, until last week, they only had 2 cases for the whole 4 months. They're now up to a whopping 11. But again, it's not uniform. So be aware of that and look for what's going on in your locality. Next slide. So what is COVID going to do long term? Well, short term, we have more people passing away this year than we were expected to have due to the virus. So will the virus end up shortening lives? Will there be new strains of the virus that hit us down the road? Does it impair the long-term health of the people who are exposed to the virus and later on will get sicker? Does a weaker economy hurt people's access to medical treatment, to food supplies? Delaying cancer treatments. People that want to go to the hospital and get treatment can't because the hospitals are closed. Would that impact shorter lives? On the other hand, of course, as an actor, we're supposed to speak both sides. Can COVID result in longer lives? Because there's a survivorship bias. If you survive COVID, maybe it makes the whole population stronger. Secondly, with more hand washing and more social distancing and things of that sort, are we protecting ourselves not just from COVID, but from other illnesses and diseases? And then lastly, cleaner air. Without so many cars running every day, the air is actually better. I mean, I've heard reports in some countries where they were still burning a lot of coal, that the factories have gone, some of the air is actually much cleaner than it was. So that could result in longer lives. So at this point, it's too early to tell, but we need to keep a look on these things and watch what's going on. Next slide. So here is a scatter chart of different professions and the impact of COVID. It's a very busy chart. When you get done with the webinar, you can pull it up, blow it up, look at the details if you want to. But the point here I want to make is that professions have responded differently to the impact of COVID. In the upper right-hand corner, on the right-hand side of the page, is your medical profession. That is the highest incidence. Those green markers over there on the right are very high incidence of COVID-related impact. In the center, you see others, and on the far left, you see people that work in offices that are able to work at home are not going to be exposed to the virus as much as others. In the center, I think it's kind of interesting, and if you get a chance, blow this up and look at it, but just looking at teachers, you would think teachers are more homogeneous in their structure of their work environment, but secondary school teachers have a much lower incidence of getting COVID than middle school teachers. Middle school teachers have a lower incidence than elementary school teachers. And if you're a kindergarten teacher, then you're very exposed to the possibility of getting COVID. So you have to look at these things in the different professions. How does it matter to you? Well, again, firefighters are way over to the right with a high preponderance of getting COVID. Police officers are a little less than firefighters, but still a lot of incidents in getting it. This then means you have to look at your particular group of employees and decide how have our employees been impacted by COVID? How does it bother the workforce? I mean, a friend of mine in California who was a paramedic went to a house, took a woman to the hospital, got the disease. He and his partner both got the disease, and then the station had to be shut down. So not only were a number of particular direct paramedics in contact with it, but others in the department in that particular county in California were also impacted by shorter staff. So again, all of it is melted together. Next slide. So this slide is really interesting. It's hard to see, so just bear with me. But it does show the riskiness of different jobs. And the only one I want to point out here, in the lower left-hand corner, you see a little dot over there. The profession that has the least likelihood of getting exposed to COVID are loggers. So loggers aren't around people, they're in the woods. So if you're in a logger plan, you got loggers in your plan, they're probably protected from COVID. The rest of the thing matches the last chart we just saw. Next slide. So what are the takeaways for plan sponsors? As Wendy said, don't panic. Take measured responses. Take your time to do something that's right. Adopt appropriate legislation for your group. If your group has particularly a number of COVID issues going on, look at the legislative opportunities and do it what's best for your group. You need to increase and maintain employee communications. With people working from home, they feel isolated. you need to do your best to make sure that your employees are in contact with, I'll call it, with contact with the mothership, if you will, so that they're not alone. They're still in this together with you. And then help all employees try to improve their financial security by education, by different ways of doing it, maybe just helping people understand what's going on. And then we talked about it earlier, revenues are going to be down for most public entities. So you have to balance the plan sponsor concerns with the plan needs. It doesn't do the plan any good to make the sponsor go bankrupt to pay for all the needs of the retirement program. But there's got to be a balance between the two because you rely on each other. Next slide. I think that completes our prepared remarks. Hank, if you want to take it back for any Q&A.
Great, thank you, Rocky, Wendy, and Melanie. So let's start with some questions. Let me start with you, Rocky. There's a question regarding, I believe it's on chart or slide number 17. The
Okay.
states that are in gray, what does that indicate?
Two more, there. Okay.
So if you're grayed out, does that mean there's minimal revenue impact?
My understanding is minimal, Hank. It could also mean that the data is just not sufficient yet. They have not done the revenue projections in those particular states.
Got it.
Right. Yep.
All right. Next question. Emergency savings account seemed like a good idea. What should I be considering before I take steps to implement? Wendy, I believe this is to you.
Yeah, I'll go ahead and answer that. As you could probably tell from my prepared remarks, I'm a big fan of emergency savings, especially within the public sector where the 457 plan hardship withdrawals are harder to get because they have to be unforeseen, something that you couldn't have predicted happening. So I think it's a prudent and incumbent on public sector plan sponsors to think about the fact that people should have some liquid savings to be able to dip into to meet emergency needs. So when you look at emergency savings vehicles, there's a couple of paths to do. First off, I think what you ought to make sure you're doing is communicating to participants about just basic financial literacy. It's now being taught in schools, which wasn't true when I was in school, but people are starting to get, curriculum that actually addresses the basics of financial security in terms of savings and assets and so forth. But then when it comes to the tools that you want to offer as a plan sponsor to your employees to help them reduce their stress due to, not being able to manage credit and, buy a house when they want to and things like that, that what you want to do is integrate that as fully and robustly as you can with all of your benefits programs. So for example, there often is a disconnect between retirement and health and welfare when they're really, intricately, well, they're linked, let's put it that way. And make sure that you're looking at that from the holistic perspective, make sure HR and retirement are both looking at the same issues and providing the same sort of advice and guidance to your members or participants. And then when you actually look at deploying some sort of financial education modules and trainings and seminars and things like that, look at what your service providers can make available, as well as what independent educators and other kind of formats can provide, and make the decisions that you think will best fit for your employee population, and just realize that it has to be repetitious. It's not something that you just go and say, oh, we're putting this in financial wellness program in and it's great, and then never talk about it again. You really need to integrate it into all sorts of touch points during the year, employee benefit, fairs, new hire orientation. Just make sure that it's, part of your basic block and tackling.
All right, thank you, Wendy. This next question is for Melanie. If a plan wants to adopt the optional CARES Act provisions, such as in-service distributions or say increased loan amounts, does the plan have to give participants all that the law allows, or can they limit it to what they want.
Okay, so as you alluded to, the coronavirus related distributions and the loan provisions that are optional changes so that a plan sponsor can not adopt them if they don't feel like they are helpful to their plan. But if they do adopt them, they can make them more restrictive than the statutory language, but they can't make them more generous. So I have seen a number of plans only adopt the coronavirus, the in-service distribution provision, but not the loans, or only adopt the loan repayment delay, but not the increased loans. I have seen plans that have adopted a loan increase that's somewhat less than 100% of account balance, so things like that. And so you can make some modifications to those provisions that fit your plan, and I encourage you to do so if you feel that's appropriate. But first check with your record keeper, because they have to program those changes, and they have to program for a very short period of time, just a few months. So any customization, they don't want to get too much in the weeds and too complicated. And then I should also point out that many plans have decided not to adopt any of them and have instead done things like remind participants that they can take a hardship or distribution or an unforeseeable emergency distribution for almost all of the same purposes that are in the in-service distribution rules. Or if you have a corona-related virus event, that you can take a second loan from the plan, which they may not currently offer, but they amend their plan to do a second loan. So there are different ways that you can address this that not necessarily are in the CARES Act, and you can also customize the CARES Act provisions to meet your needs. And then one last thing on that is the required minimum distribution waiver is required under the law. So that means any payment that you make to participant that would normally be a required minimum distribution is not considered that. But plans have some wiggle room in how to do it that fits their needs. For example, if someone's receiving monthly installments from a defined contribution plan, they may not stop those automatically, but give the participant the option to stop them if they want to. But if someone's receiving a lump sum, that's just the minimum amount of the required distribution for the year, they would stop those automatically and then give them also the option to get the distribution if they want it. So there are ways you can customize even the required change under the CARES Act.
And Melanie, just a quick follow-up. For your clients or just plans generally that do opt to implement the CARES Act provisions or the hardship distributions that you mentioned that already pre-exist, what's sort of been the uptake of those options? Do you know, or plan participants taking advantage of these provisions?
Right, so I have some sense of that, and then I'm gonna let Wendy weigh in because she has a great relationship with the record keepers and talks to them about what they're seeing as well. But I would say what I've heard is that in the public sector, we're seeing about 80% of plans adopting the in-service distributions, but a much less percent, 30 or less percent adopting the loan provisions. And then the uptake is even less than that. And I don't know if I have an exact number, but I think Wendy's provision kind of alluded to that. So I'm gonna let her talk about those statistics.
Well, I will say that the public sector, I think, is a much more on the ball than the private sector in terms of adopting the CARES Act requirements. I have seen, especially in the early advent of the virus, that many plans were going ahead and just adopting the maximums. Then it has decreased a little bit where people are maybe not making the full amount available that they could have. But I do think that, people are not unnecessarily taking money out that they don't need to take out. And I do think that it is going to get worse before it gets better. So I think that having, acted early means that when people are being evicted or things like that, as this pandemic goes on much longer than any of us really thought it might, that they'll be, able to access that funds and then use that money for, real, true, dire emergencies. They're not going out and buying speedboats with the money. Let me put it that way.
Right. Great. Thank you. This next question, Rocky, I believe is for you. You talked about, options for short-term relief without jeopardizing long-term health of the plan. Can you expand on that and provide maybe some options that plans might be able to explore?
Sure. Let's talk about the investment side first. Almost all plans in the country have asset smoothing in place. Typically, it's a 5-year asset smoothing setup with some type of market value thing. After the economic collapse in 2008, ERISA actually gave the right for multi-employer plans to expand that 5 years to 10 years for a temporary period. So, and I had some public sector plans that expanded their smoothing period from 5 to 10 years and expanded the corridor. Usually the corridor is 120, 125% of market. If the market was a particularly dire decrease, you could expand that out to 130, 140% and give yourself some wiggle room to allow the markets to recover if we think that's going to happen in the year after, as it did back in 2008, 2009, 2010. So that's one way on the asset side of using your smoothing method to help you get some relief in not hitting the contribution requirements immediately. As far as contribution requirements are concerned, because of revenue, the other thing you can look at, and again, it will vary by plan because plans start at a completely different place. But in your funding policy, for example, in the state of Georgia, state of Georgia has a maximum amortization period of 30 years. And many of the plans in the state have gotten their amortization period down to 10, 12, 13 years. So if the particular hit on the revenue is difficult, they could take that amortization period they're actually funding over, expand it out to maybe 15 or 18 years, give themselves some budget relief for a short period of time, and still remain in compliance with state law. If, on the other hand, you're in a state that doesn't have any minimum funding requirement laws, and you're very limited as to what your options can be, especially if you're out at 30-year amortization already, that becomes more difficult. At that point, you have to look at what the revenue is and how the impact of a shortage would be if you pay 80% of the ARC versus 100% of the ARC for a year or 2 years. How will that impact the plan long term, and do some modeling on that. So those are the two areas that you could probably do the most good for yourself in looking at what the budgets might be for short-term relief without impacting your long-term funding policies and objectives.
Great. Well, Melanie, Wendy, Rocky, thank you for this wonderful presentation today and sharing your knowledge with our attendees. And thank you to our audience for joining us today. Join us on Thursday for our next webinar entitled Sustainability and Affordability of Public Pensions Despite the COVID-19 Shock. It'll be an overview and discussion on recent NCPERS research publications. Thank you, everyone. Have a good day.
Take care. See you guys.
Bye-bye.